The great thing about effort is that it's attainable for anyone. It's there. Regardless of your skill set, you can go out and hammer 800-meter repeats, right? I mean, maybe you can't do 5 of them, but trying hard is available to everyone.
Hey everybody, welcome to the Build to Billions podcast, where we guide successful entrepreneurs and investors on the journey from millions to billions. We believe the key to scaling and compounding your wealth and life starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth and life so you can give more all of it away to help MVPs, the most vulnerable people. My name is Brett Swarts. In every episode, I'm joined by the world's top entrepreneurs, millionaires, and billionaires. They share their secrets, wisdom, and insights so we can all level up and make a bigger impact. I'm excited about our next guest. He's a longtime guest of the Capital Gains Tax Resistance podcast. I think he's been on the Build to Billions as well before. He is a seasoned real estate investor with a strong background in economics, which has shaped his comprehensive and data-driven approach to analyzing real estate opportunities. His expertise offers a unique perspective on out-of-state investing, helping clients navigate markets beyond their local footprint with confidence. He is the founder of an investment firm, and he's dedicated to helping clients across access passive cash flow opportunities to deliver strong returns. A lot of it multifamily, a lot of it these days in the Arizona, Phoenix area market. Tons of experience on helping to raise capital. He's an authority in that space. We're talking about that today. Please welcome to the show with me, Mr. Hunter Thompson. Hunter, how are we doing?
Hey, thanks again. Really appreciate it. Excited to dive in today.
Great. And for our listeners getting to know you for the first time, maybe give them the 30-second overview and then like the 30-second focus as well.
Sure. So I founded 2 companies, ACM Capital. That's a company where we buy deals directly, though I started out as a capital allocator around 2010. Scaled that up to raising about 9 figures of equity from investors and working with some excellent operators in a variety of different asset classes. 2022 came around, which I'm sure we're going to talk about in a little bit, where interest rates rose faster than they've risen in 40 years. It created serious distress in multifamily, and I thought it would be kind of the opportunity of a generation, to be honest, for reasons I will talk about. And we kind of stopped looking at anything other than multifamily in Phoenix. My partner moved to Phoenix, then I moved to Phoenix, and this has been our number one and only focus ever since. And I also have a e-learning coaching business that helps people learn how to raise capital, and that's raisingcapital.com.
Excellent. So we're going to be talking about the year of the multifamily tap out. And by the way, we also think this is a positive thing because it's an opportunity to be a buyer. But let's just talk about Hunter. You know, this year, we talked before the show, that people have been in an arm bar, people being the multifamily syndicator operator, and the arm bar, let's say, started in 2023, 2024. They've been holding on. Maybe they did a sweep or 2, but now they found themselves on their back again, and that arm is about to get snapped, and some of them are just handing the keys back. So are you seeing that? Do you feel like this is finally the year when things are hitting the bottom, or are we still in this extend pretend world?
Well, good question. Number one, in Phoenix, which tends to lead the country, not be number one necessarily, but certainly one of the fastest moving. So I would probably think it would be one of the fastest in terms of rebounds, because there's more transactions typically, and there's so much investor appetite for Phoenix that it will go down faster because you see more volume of transactions, and will go up faster. This is true of basically all the recent recessions. And that has certainly happened in Phoenix. Like, the bottom has certainly been formed in Phoenix. I mean, to create a new bottom, sure, it's possible, but it would take additional factors. In the current economic landscape, the bottom has been formed, if that makes sense. So if we had a massive sell-off on the stock market, like a 40% reduction, I could see us taking another leg down, but it would be in a different climate, basically.
Mm-hmm. Yeah, okay, that makes sense. Okay, and so give us some real life examples. I mean, I'm just seeing some of these things are really tough. And by the way, we've had some investors and some of the passive deals that we put into that are literally just complete losses. And the gap between what was owed and the equity of the value of the property is just so far. It's such a big bar. It's a big margin. So break down to me some examples that you're seeing and what people are feeling out there.
Well, let's take it back to 2017, 2018, 2019, because I was, at the time, had been in the business for quite a while and saw the popularization of the world of syndicated investments, and to some very small degree played a role in that popularization through podcasts and marketing and these types of things. And I got to feel what it's like to to be part of going from the bottom, which is where I started my career in 2010, to where you had to be insane to invest in real estate, basically. And that's what you heard from your friends and family and people you respected, by the way, and people who rooted for you would say, hey, like, don't do that. To every dentist, they doubled their net worth just between 2018 and 2020 if they had invested in syndications. And so when you see a dentist that's your coworker double their net worth because they know something you don't know, you start to know it. You learn it. And then every dentist and doctor and lawyer wanted to do the same. And so you see this pile into the world of syndications in 2019, 2020, 21, 22. And then the Fed raises rates, like I said, fast, and they've risen them in 40 years. Your listeners have probably heard this story before, but I'll just keep it brief in terms of my perspective. What this created was that you could essentially only make deals pencil in that run-up by using floating rate debt in competitive markets, meaning the booming markets like Tampa, Houston, Dallas, et cetera, Phoenix, et cetera. And so when rates went up, people weren't in these fixed rate products that didn't matter. It was very sensitive, and you could see interest rates in these deals double, which it doesn't matter how good of an operator you are. You can renovate your little heart out. You can't account for interest rates doubling in a sensitivity analysis in a competitive market. So this created distress in deals. And if you were involved in deals like that, which of course I was as well, this doesn't mean you're not cut out for it. Doesn't mean that you aren't capable of it. It just means that this is what makes a market cycle. It's more powerful than the human brain can really. We want to fight against our eagerness to make mistakes, but there's a reason it happens over and over again and will always continue. And so there you go.
Let me cover this real fast. This is really key because sometimes I'm torn a little bit this, I go like, hey, the debt doubled, right? So let's say, if you had on a scale of 1 to 10 or on 100%, like the deals that are completely falling apart and failing, right? Obviously the timing of it wasn't great. They're in a competitive world. It was floating debt. But if you had to gauge it, and let's just say insurance, right? Doubling insurance, sometimes tripling insurance in places like Texas and Florida and different areas. And then you have debt that's, doubling, right? And that's crazy. And then you have property taxes also kind of could be off the charts here. Versus operations. I kind of want to get a sense, Hunter, if you had to peg it on a 100% like fault, people failed, what percentage of it is, 50% debt doubling, 30% insurance, 20% operations, or hey, your operations were 60%, and then these are 2020. Like, give me a sense for that, because I'm trying to learn from this, but I also have investors that are like, man, like what? Like, I mean, they're upset and they're just trying to get the story. And too often, I think it's easy to say, yeah, well, it was the insurance, and yeah, it was the debt, and yeah, it was the taxes, but again, you're on the inside of this, and you're in front of a lot of folks. So give me just your. I know it's not going to be the same for every market, but what do you think the percentages of fault, if you had to peg it, would be?
Well, I can give you an answer that doesn't exactly answer your question, but I think it'll probably give the listeners a very helpful tool.
Okay.
All you got to do is just assume a purchase price of 10 million and assume 60, 70, and 80% loan to value. Do those exercises separately. Let's see, you take 60% loan to value, 70% loan to value, 80% loan to value, and say you start with a 3.5% interest rate. And what would the debt service be on that deal? And you can reverse engineer what kind of property you'd pay $10 million for if you know much about NOI calculations and cap rates. And then assume the debt goes from 3.5 to 7. And what you'll find is it basically doesn't matter what happens. There's no way you can pay it, and then let's assume there's some headwinds in the market. Then you for sure can't pay it. So it's like, it's easy for me to come on and say like 100%, but the truth of the matter is, if your debt doubles and you're leveraged at like a normal 70% LTV, even if you increase NOI by 20%, which would be like you did a pretty good job, you still can't get to break even. And most business plans don't think you're going to increase NOI by 20% unless there's a heavy value. So you get my point. It's like, that's how significant that is. And I didn't run these numbers before this conversation, so I don't remember them offhand. But I suggest, if you want to know the answer, just run the calculation and you can see why lower leverage matters, but also you can see why floating rate debt has its risks and benefits, and why buying with fixed rate debt is literally a totally different investment profile in terms of risk. It's completely different. Like the likelihood of capital calls and challenges. Let me give you an example, and we're getting detailed here, but I had an investor reach out to me complaining about someone else's deal, not our deal, someone else's deal. And they said, "Hey, this sponsor is going to ruin their reputation. I've done 17 deals. Only one of them lost money." And I go, "How many have floating rate debt?" And they go, "One of them." And I go, "Let me guess. It's the one that you're going to lose money," because like that's how obvious it is. Now, of course, LP investors, they may not know that, but to me, I'm like, you know, this is the reason that there is such a big difference. And perhaps they didn't know at the time, and maybe the sponsor should have done a better job of sharing the risks with them. But, you know, that's really unfortunate, right? It's like, no, this sponsor is going to ruin the reputation. I'm like, actually, every sponsor that used floating rate debt is in this situation, regardless of how good they are. So there's your answer.
Okay, I think this is great. By the way, Hunter Thompson, everybody, you want to learn more. He's masterful at everything that he's talking about here. And I think he broke it down so simple. This is part of why he's so great at what he does. He helps fund managers and passive investors achieve asymmetric returns through Phoenix multifamily real estate. You can go to asymcapital.com. So I'm going to try to re-say this to see, make sure I got it. So it sounds like the big domino, if you just run the simple math on a $10 million deal at 3.5% interest, a 7% increase on a typical 67% LTV, you would have to grow it by 20% NOI, something like that, right? In order to even still be going okay, which is A, not realistic, and B, the rest of it kind of becomes a little bit irrelevant to Hunter. The big domino is this interest rate that has doubled on any given kind of mathematical equation. That's just what it is. Is that a fair summary?
Yes, but then that doesn't even factor if they didn't get a rate cap or if the
Right.
rate cap expired. Like that's kind of like the reason I use that exercise. It's not like a best case scenario, just to be like, listen, this is a nature of financial distress, not operational distress. And so it doesn't help if insurance costs double or
Right.
4x like they have in some markets in Florida and Texas. But that's not what's really causing this. And so you can even look at it from like a rental income perspective. It's like, you know, people complain about additional supply coming online. Well, great, that maybe reduced your asking rent by, 8%, but that's nothing compared to
Right.
like your debt doubling
Right.
essentially. And that would be, 8%, that would be a big reduction, but that's not going to create distress. That's the beauty of multifamily is that rents are very sticky. 3% loss in rent would be pretty significant. And so, we're just kind of playing this game. And but here's the thing though, as we will talk about in a moment, it's not that everyone just all of a sudden was an idiot. It was that it was impossible to make deals pencil for years unless you took that risk. So you were faced with the opportunity as an investor or as an entrepreneur, business owner, to sit on your hands. If you wanted to buy deals in Phoenix starting in 2017, you could sit on your hands. You could start buying deals in a market that you have to take 6 connecting flights to get to. That's also an option. Or you can try to be a normal market participant and like look up, what do the bond traders think? What do the smartest people in the world think? What's the Fed saying? And make an educated guess around the future of interest rates. You could look at the last 100 years of interest rates and realize that interest rates kind of trend down and to the right over the last 40 years. So if you generally used floating rate product over the 40-year period, you win. And you generally don't think the Fed's going to raise rates faster than they've risen them in 40 years. These are just normal. The reason I wanted to say this is that that's what makes a market cycle, is normal people making educated guesses and then some unique thing that seems totally impossible happens. I used to hear that stuff when I was younger and be like, yeah, but dude, I'm the guy that's going to clearly see it coming. And it doesn't work like that, and that's okay. That's why it's so fun. That's why it's so lucrative. That's why the doctor did double his net worth, and he worked his whole career, and then all of a sudden he doubled his net worth. I mean, this is an amazing game. But if you stick with it, every cycle you get better at hearing the signs and knowing what to think about, and it makes you a better man. It makes you a better, husband, wife, etc. And this is why it creates outsized returns. So we're going to talk about what's going to happen in the next 5 years, but
Yeah.
this is okay. The fact that there is destruction is part of this game, and
Yeah,
it's not
very
fun.
well said. I appreciate that. Yeah. So if I had to pay it based on what Hunter said, I'm just going to put the percentages there. It sounds like 80, 90, maybe even 95% was the debt. okay, then the rest of the things, yes, they didn't help and they could have maybe been changed. But if 80 to 95% of the momentum of the ship is sinking, it didn't matter how many holes you try to plug, the hole is so big that the ship is going to sink, right? So, okay, excellent. So now let's talk about opportunity. Now let's move to the positive, right? That's what's happened. Yes, by the way, what did we learn from this? We learned that fixed rate long-term debt is something that we're all going to be much more attuned to, right? And much more aware of, right? And then B, yeah, you should always look at the track record of the groups. But C, those who have floating debt, no matter how operationally excellent they may be or have had in the past, they are still getting hit or hurting or losing these opportunities, losing these deals without having to pour a bunch of saving capital into them. So okay. Anything else to add there, Hunter, before we move to the kind of the opportunity side and what you're seeing in Phoenix right now?
Well, they're tied together. So because of this, my perspective, this is a generational type of opportunity because you don't typically see destruction and correction in multifamily. That's unique. If you were to see a 25% reduction of valuations in multifamily, that's historically significant. We have a deal that's under contract that we're buying for $186,000 a door in Phoenix, 80s build, quality asset, very clean property, no heavy rehab needed. The property next door sold in 2022 at peak pricing for $300,000 a door, same kind of vintage. That's a 38% reduction to peak pricing. That is awesome. But it's not just that. It's that this correction has not been caused by everyone's leaving Phoenix and no one has a job. And when I go tour a property and then get in an Uber, that guy didn't used to make 180 grand and now got fired and now he's no longer an engineer. He now has to drive. That's not the story. The story is, generally speaking, the economy is solid. We don't have 12% unemployment. We don't have a spiraling death cycle of foreclosures and illiquidity in banks. This is a situation where you've got significant price correction without that correction going out into the overall economy, into the global economy, like you did in 2008, where you can't even borrow money to buy the property even if you liked the deal. So that's why I say it's generationally important, because when else can you get those kind of distressed sellers or distressed prices? But generally speaking, things are going pretty well. And you and I can complain about things about the government and things, but I mean, generally speaking, you're not seeing this like crazy destruction in the overall economy. That the stock market is at all-time highs. So the combination of all those factors makes this an incredible time to potentially take gains from the stock market, buy great real estate at an incredible discount, and use fixed rate product, which, by the way, now you're getting the best of both worlds. Lower basis, higher cap rate, lower leverage, fixed rate debt, longer term debt. Every metric you would use to determine the risk profile of the deal is cranked the other direction as it was in 2022. And that's what I'm here to do.
I love it. By the way, plus big beautiful tax law passed, and you have 100% bonus depreciation kicking back in, which is another gravy on top, which also led to part of the massive appreciation back there. But it's a good time to get it back. Might as well have it on your side. By the way, you can still take gains. Hunter is all correct there, but you mentioned one thing. You don't have to take the gains. You can defer the gains and still go into Hunter's deal using what's called a deferred sales trust. What we specialize in works for Bitcoin, works for businesses, works for public stock, private stock. We're actually working on an NVIDIA stock sale right now for someone who wants to sell and has massive gains there. So if you want to learn more about that, go to capitalgainstaxsolution.com to keep more of your gains compounding in your favor and going into passive real estate if you'd like to do that. Okay, keep going here. So I love it. $186,000 a door, 80s construction, 38% reduction. Anything more about this deal as far as units, average cash on cash, just kind of some general terms there to get a feel for it, Hunter?
Yeah, I mean, you could take a look at the details depending on when this airs at asymcapital.com. But here's the thing that I wanted to share in the context of this. So, and this is part myself as well. Like, you can hear from my voice, like, I am a very competitive person. I like to win. I also thought I was right in 2010. Oh, either I'm the smartest guy in the world or this is wrong. And that's just my attitude. And it helps you as an entrepreneur to kind of think you got a leg up, because it allows you to move faster, which is actually the key to getting success. But because I have a podcast like you, I say things dumb sometimes, and I'm not right all the time. And unfortunately, I'm recorded, and every year I say something and I regret it and these types of things. But one of the things that I thought, and it just didn't play out that way, and now looking back, it's so silly, is that I saw the rise in interest rates happen. My partner moves there to take advantage of this. My wife is getting pregnant. And at 8 months pregnant, I'm like, now is the time we got to do it. Before we had the second baby, we're going to plant our flag in the ground and say, this is it. And, I go here and I just wait, basically, right? We plan to do 4 deals a year from 2022. We've done 2 deals in the last 2 years. And I dramatically underestimated how hard it would be to buy these deals. So think about it, right? You've got this massive destruction. You've got crazy discounts like the one I just mentioned, which is real, by the way. And I'm just like, we're going to back the freaking truck up, But turns out, who the hell wouldn't? Who the heck? It's clear as day. And it's not like I've got access to some unique algorithm that only me and Tyler see. No, everyone sees. Guess what? Interest rates rose, massive decline in valuations, and you can't develop now because interest rates are too high for developers. So you see 200 people to move into Phoenix every single day. There's a $165 billion Taiwan semiconductor development taking place. Everyone knows it's popping off. So who would want to sell? And the answer is nobody. And so they will do anything they can to hold on because they see the same thing I see. They see this massive demand curve and a drop off of supply. And so you have a property, you just know, bro, you get into that meeting with your committee of investors and you go, we just got to hold on until 2027. Who has $1? Throw $1 in. You have a nickel, throw a nickel in. And so the only deals that have fallen through are very unique and kind of property specific. So this deal is a 35-year owner where the patriarch of the family passed away, and that's now an estate planning type of situation. And they're forced to sell in this environment. And dude, it's crazy because as much as I talk about the distress coming from debt, which is true, almost all of the transactions are unique kind of property specific situations where they're forced to sell, but at a ridiculously low basis where they wouldn't want to otherwise. And that's what it means to make a market too. So when you say, and I know I'm going on a rant, but it's a tie into what you got to say here. When you say this is the year that the Brazilian Jiu-jitsu taps out, it's easy from the outside looking in to be like, just don't tap, bro. But as a business owner, think about it. My partner, he's got his wife. Hey, we're moving to Scottsdale. We're following our dreams. Me, I got my pregnant wife. Hey, we're going to plan up shop. Well, guess what? How many quarters can you go as a company before you start saying, dude, I could go wash cars for a living and make more money than this. And so people bail, not just because of bad deals, because there's nothing happening. And that's what really makes this compelling is that if you can make it just one day longer than everyone and then make it through the next cycle, you will be an industry leader because there will be no one else left. And that's it. That's the playbook. Make it one day longer.
Okay. All right. By the way, this is very well said. Yeah. With death, divorce, debt, what are the other? There's like 5 Ds that people sell. I'm like, yeah, this is a classic example that you found a deal due to a death and estate planning. It's going to happen in every marketplace. And yeah, very well said. Okay, so more opportunities. So this is a good opportunity. Any other ones that you're seeing, or I guess any other creative ways to find opportunities, or even to raise capital these days? What with your business, we can kind of shift into that. Go ahead, Hunter.
No, this is perfect. So
Yeah.
we are hyper focused on Phoenix. And without that, I don't know how we would get a deal done, right?
Mhm.
We're the first people groups look at when the buy box meets our criteria because they know we can get an offer in 48 hours because we know the property already. We know the vintage, the side, the builder. We know the vendors we would use to renovate the property. We've looked at the 3 P&Ls and the closest property. We know the market, right? So we're going to be, and by the way, my partner's golfing with the brokers every Saturday, right? So that's how you get real deal flow in a climate. You have a specificity, which is exactly what we have. Now, in terms of raising money though, now we get to experience this part of the market cycle, which is that there's people that have had bad experiences that will never participate again. There's people that have had bad experiences that are willing to participate again, but with an entire different view where, hey, now the conversation is, oh, what's the loan product look like? Is it fixed rate debt or floating rate debt? Oh,
Yeah.
it's floating rate debt. Okay, cool. What's the loan term? Is there a debt? Is there a rate cap? How long is the rate cap? How much would happen if there's a level of due diligence that just they would not have gone through before? And that's what happens when you're a seasoned investor. But now it's been a couple years. So what does that mean? There's now the new, hungry, evangelist investors that are already experiencing success, and even their competitors or coworkers are having FOMO. And so now you have the next iteration of eager capital that wasn't impacted by the last run up. There are people just now finding out about Brett Swarts and being like, this guy is a freaking genius. What is crowdfunded real estate? Is this legal? They're Googling terms like that. And that, my friends, is what makes a market. And so those people will go on a journey that they will go from, young, hungry, I'm smarter than everyone, and I'll always see a black swan, to, wow, oh, that's what it means. Okay, that's how you play the game a little bit better. And, this is how it all goes. And so one of the best ways to raise money right now is to tap into different pockets of high income CPAs. We just joint ventured with a deal where half the money is coming from high income pilots, and they're getting in at a perfect time. And eventually they will be old, crotchety men like me. But right now they've got the best opportunity that the world has seen in, 10 years or something like that. And that's what they're going to take advantage of. And this is just my opinion, and I'm trying to be entertaining as well, but you get my point.
I do. Yeah, I do. And this is, I like the way that you put all of that. And then what about for capital raisers, is it now getting even more niche, the dental groups, the veterinarian groups, the like you said, the high income CPA groups that have access to those folks, or high income pilots? What have you found to be the best strategies for those who are, hanging on by a thread and need to raise some capital to make it to 2027?
Well, number one, if you're listening to this, you've probably spent some time on something that is very lucrative that your friends and coworkers don't know about. And so the coolest way that I have found to capitalize on that is by raising capital for other operators that are hyper focused on one strategy, And so if you're listening to this and you are, let's say, a high income tech executive, and your friends are high income tech executives, and you've got like people that are making $200,000 a year or more in your network, you can partner with groups like mine or others, but you get my point. We cater to those groups and create a structure where you can create your own LLC, pull your 10 doctor friends into that LLC, and your LLC will get better terms than if an individual investor invested. And you can essentially keep the difference between the individual investors and the big investors. You yourself, we call this a fund manager, a fund of funds manager. So you're incentivized to go out and find those 10 dentists, but they get the same deal as if they had gone direct, and you just keep the difference that you essentially negotiated from us. And so that is a big part of our capital raising strategy right now because of where we are in the market. And it's a very cool side hustle for these dentists because they get a path to true financial freedom without focusing on operations and flying around going to Phoenix multifamily deals.
Yep, that's perfect. Thank you. And by the way, if people want to learn more about that, Hunter will be sharing, I think is it raisingcapital.com? Is that what it is, Hunter?
Yeah. I mean, I have a course that's about that topic that I'll give to you for free. It's called fundoffundsmastery.com. And when I say I'll give it to you for free, I actually sold this course for $3,000 and then was like, you know what? It's going to be a lot easier to get people to go through this material if it's free. And so I gave a lot of people a refund. I think I gave 40 grand away as a refund. So people bought it. And then I was like, you know what? I'm going to make it free. I don't want those people to get mad. So I made it free. So it's both free and also worth a lot to me. So there you go.
No, I've been through it and it's incredible. It's great. And so I love it. I think I was one of the ones who bought it and then you gave the refund, right? Because
dude, I love when people hear this and they're like, this is like a marketing situation. The guy's making a story up. Hey, it was a weird day. I woke up and I was like, I got to do it. I go into Stripe and just go bang, 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 bang. And then I send an email and go, hey, good news. You get your money back and you can keep the course. So like, it's a goodwill exercise on accident, by the way, not intentional.
It's all good. It's good. Okay. So we're at 29-minute mark. So we're kind of wrapping up. What haven't I asked you so far far, Hunter, that you want to make sure you share that that you're seeing out there or that you think would be helpful? Like, and any really just kind of the open question here for you to kind of ask yourself the own question and answer it.
I'd say that with any of this stuff, going all in is going to give you better results than being perfect. And so you want to be measured in terms of where you are, but wherever you are, you should go all in, right? So meaning that if this is the first podcast you've ever heard, maybe going all in is listening to 100 as fast as you can. Like, what's the goal to get to 100? Like, what's the KPI you're going to do? Is it 5 a day? Is it 5 a week? Create that KPI. Just act as if you were a Fortune 500 company. You had a board of advisors telling you, like, this is the KPI. Did you do it? And if you're more seasoned, if you've already made some investments, like, your eyes aren't deceiving you. This really is a very, very unique opportunity to buy heavily discounted assets in an otherwise healthy economy and a healthy lending environment. So you just don't hear that many horror stories about people buying quality market deals with fixed rate 5-year financing. And so take advantage of it, because my friends, it will not last. Like I said, it wasn't that everyone was stupid all of a sudden. It was that it doesn't last. You can't do it in all stages of the cycle. You can only do it when there is depression and skepticism, and that will go away. It's kind of like Bitcoin, right? It's like there's going to be skepticism, but that skepticism will later be met with evangelism, and you want to buy when there's skepticism.
Awesome. Hunter Thompson, everybody. Hunter, ready for the lightning round?
Let's go.
All right, number one book you've recommended in the most past year?
I'm going to say Who Not How.
Perfect. Question number two, what are you most curious about right now?
Custom AIs.
Yeah, me too. I was watching some this weekend, just on some YouTube channels. I'm just kind of every week, every second week, I'm like, oh my gosh, they just did it even better and better and better. And I'm like, gosh, we're doing an AI challenge for the team next month. Or literally we're telling them, if you AI, anything that you do, you get a bonus. And the most person who do the most AI by the end of the month gets even bigger bonus. And it's not challenging your job. You're all AI experts. Congratulations, you're all been deputized as AI experts, and you need to AI basically all the repeating tasks. Okay, cool. Question number three, number one leadership quote or theme that you try to live by.
I mean, I've been in this High Rocks thing recently, and I'm gonna keep it fire round because I know that's the intention. High Rocks is an endurance race that mixes weights and running, and there's stations between every run, and it's a very unique, very difficult race. And it made me realize and remember what it's like to train for endurance. And so the quote is by my man Dylan Scott, who got third in the world at the High Rocks Championships. That the quote, "The great thing about effort is that it's attainable for anyone." It's there. Regardless of your skill set, you can go out and hammer 800-meter repeats, right? I mean, maybe you can't do 5 of them, but trying hard is available to everyone. So no matter how slow or fast you go, trying is there. And man, it's right out your door. So can I go on a tiny little rant about this?
Please do. And I'm going to add to that. I'm going to add to the kill.
Okay. I used to run in high school, and that was kind of my first identity of really hyper focus and also confidence. I didn't do very well in school, not crazy like D's and F's, but just like I didn't take it seriously, right? And so I got a very good running coach in high school, and I had a bit of a knack for it. And I realized that I wasn't a slacker. I just didn't like school. I was obsessed with running. Like that's my identity. This is what I thought about. I didn't run. I was a runner. And for some reason, because I didn't run in college, it like fell out of my life. And I always talked about, I should have run in college. I didn't have an opportunity to run D1, but I certainly could have run D2 and D3. And I got offers to do that. And I always told this freaking story. I should have run in college. I should have run D3. I should have run D2. I'd have had so much fun. And what numbers would I gotten and all this stuff. And one day I was just watching YouTube, and I saw this guy who's not a professional athlete running 10 by 1K with 1,000 meters. And I was just like, dude, he's out there at 5:20 in the morning. On the track is like other Olympians and Olympic trials competitors, but he's not on that level. It's like anyone can just drive to the track at 8:20. Like, what was I thinking? It was all right there. I could literally drive. It doesn't matter if you're running 8-minute miles. You can still go out and hammer 1K repeats. And I was like, whoa, I want to live that life. Like, I want to live the life of like super intensity, and just no one's going to pay you, but who cares? Those people aren't making that much money anyway. They're all nurses and stuff. And so I was like, I just realized they're just normal people. They're just going a little faster than me, but I mean, I'm going to go do that. And so that is attainable to anyone. And if you're listening to this right now and you're thinking, he's so right, but I had this inflammation in my hip and da. Okay, but cool. Let me ask you, on a scale of 1 to 10 right now, how committed are you? How on the line of what you're physically capable are you living? Like, are you right on the limiter? Are you making sacrifices that matter to you to pursue something excellent? Because like, if you're talking about your hip, maybe you can't run, but like, what's the modality that can put you in a place where you're able to live on the edge, where you have to make sacrifices to accomplish amazing things? And man, if we can get more people living on that, I think it's going to be a better society, dude, and a fitter society too.
Hey man, by the way, I'm going to say two things. Okay, number one, John Wooden, Definition of Success, and if you haven't got any of his books, just get any of his books. So one of the greatest coaches, arguably all time, in any sport. So success, according to John Wooden, is peace of mind, which is a direct result of self-satisfaction and knowing you made the effort to become the best of which you are capable. Right? And notice that the best that you are capable, right? Not anybody else. But it's the peace of mind knowing that you gave the very best, right? That you're capable. And so I absolutely love that about John Wooden. And I grew up playing basketball, and I did play basketball at the small NAI, school, played in college, and I absolutely loved it. I'm so glad I did. Right. And looking back, I still play. I don't stop. I keep playing. On top of that, we're building a house right now, Hunter, and we purposely are building it across the street from basically a Lifetime Fitness, okay? Because it was such a big thing in our lives in California. We moved to Florida, and I found that most people will work out more consistently if they didn't have to take so much time to drive or go to the thing, right? So getting up and literally walk, I mean, it's a 30-second drive actually. So, and it's a beautiful community. And on top of that, we actually moved across the street from the actual fitness center in the community. Cause I was like, I think I'm going to work out twice a day. Like, I love working out. What are the things that are painful? Well, things are painful is having to drive there and the park and do the thing. Like, but if I can just wake up and roll out of bed and just walk over there, it's so much easier. And then on top of that, I'm like, kids, you don't even know, like growing up, like I had to, sneak into the gym that was, 4 miles away from the high school. I had to drive, this is like the story that the snow uphill both sides, but I had to literally ride my bike in 100-degree weather, 5 or 6 blocks to my friend's house, my brother's best friend's house, who had like 25 cats, into this garage that had the jankiest, bench press and dumbbells, and just, sweat it out in the middle of I loved it, but I mean, so I'm just trying to cut down the amount of time. So I think the new living is basically, and we saw this before COVID, right? Living downtown and having walkability. But I think the newest living is, that I think is amazing, is beautiful areas, obviously great schools. We're going to be like 5 minutes, 7 minutes from the beach. We're going to be just 30 seconds from Lifetime. To me, I'm like, this is my dream, baby. Like, I don't have to worry about the hurricane crashing into me. I can be 7 minutes from the beach, but I'm 30 seconds from Lifetime. I'm across the street in my backyard. I don't need to have a big backyard because I can go across the street to the 2 pools and the whole thing. Like, I'm so excited about this house, dude. And it's coming up. I'm like a month away from closing. So any thoughts on any of that I just said?
Well, yeah, I mean, I moved to Phoenix, like I talked about. I had a home gym in LA. I almost sold my equipment, and I'm so glad I didn't. And I moved it to Phoenix, and now we're renting because I didn't know exactly where we wanted to live and these kinds of things. So I put all this equipment in this garage and set it up, obviously, but it's obviously hot here. And so there was definitely a moment where I was like, am I going to have to go to I actually go to Lifetime as well, but it does add about, for me, like with the drive and the whole thing and like getting clothes and packing the whole thing, it adds a little bit of friction. And so I have been doing almost all my workouts in the garage. And there's a tie into this other conversation, which is like, my buddy, I was going to go and do a run in a treadmill on the garage. And my buddy's like, dude, what are you doing, bro? It's 112 outside and the garage isn't air conditioning. Well, I got a little vent. I got a little fan that makes it maybe like probably in the 85, 89 kind of thing in the garage. But he's like, dude, it's going to be hard. I'm like, yeah, but like, what I'm going to go do is hard. Like I'm not trying to optimize for not hard. Like that's the whole point. Like I'm just, what I'm going to do when I get in there? Like I literally, I'm going to set the treadmill to 15% up and like go at like 5 miles an hour for an hour. So like it's not like, oh, make it a little bit cooler and it'll be different. Like it's going to be hard no matter what.
Yeah, that's spot on. Spot on. Let me finish this thought too. My kids now have a chance to walk. They have no excuse. They can walk across the street and they can work out with dad and mom. And like that can be literally every single day. So one of the non-negotiables for me is to literally work out every single day. Now there are times when I work out, like I worked at like, I think 5 straight days. And so today I actually took a rest day, although I walked around my neighborhood, but but like trying to get the 5-6 days a week or some jiu-jitsu mixed in there. I'm doing jiu-jitsu, basketball mixed in. That could be a workout day too. It doesn't always have to be heavy, weights, but I just think that sets you up, your mindset, your discipline. It's one of those core, hopefully make it a non-negotiable habit for the rest of your life. Last thing I'll say with kids, 85% of their habits are basically instilled by them before the age of 16 or 18. Okay. So in other words, it's so easy to wire the habits in kids, and it's so much more challenging once you're past that 18 years of age. So I was telling my daughter this, I'm like, hey, it can be hard now or hard later, but let me tell you, when you're past a certain age, it's like twice as hard to establish this kind of habit. So why don't you start coming with me to jiu-jitsu? And she did. All my kids do jiu-jitsu now. They all love it. Why don't you start coming with me to work out? We'll work out together, right? So we get some one-on-one time. And she's loving it. And she's getting to the point where she's asking me to go. Can we go in tomorrow morning? I'm like, yeah. And so I'm waking her up. We're going. And, I just think that's so important if you have kids to make sure you're modeling with them, inviting them into it. And being able to create, these memories, but these core habits, like it's such a game changer. And her confidence is soaring, right? Her demeanor, her health, like it all just starts to compound.
100%, man. And there's something to that. I want to mention the 15%, just so the nerds out there that go and try to do that workout, that is the workout, but I was doing intervals, right? So it wasn't like, I think it was like 5.4 to 5.7 miles an hour. Okay. 80 seconds on, 80 seconds off. So if you go and try to do it, don't do it for an hour straight. That would be like real David Goggins level stuff. But I just wanted to make sure. But yeah, that's literally what we like to do. We like to do hard stuff because if you can do the hardest thing to yourself all day, everything else is kind of, if you're running up a freaking imaginary hill at 15% incline in your spare time, your wife being like, oh, you forgot to take the trash out. It's just not going to move the needle. It's not, oh, no, I didn't take the trash out. You didn't. You forgot. It's like, that's not, you're going to be like, oh, that is nothing compared to what just happened to me in that gym. So
let me add jiu-jitsu to that, dude. I roll 100%. With these guys that are 250 pounds. I'm up like to like 175. I've been lifting pretty hard, but I'm usually like about 170. Okay. And some guys are like 220 and one guy was like 270. I'm like, this is like, it's a lot of weight. Every 30 pounds is a lot, and like I'm going, and these guys are purple belts and blue belts, and I'm still the white belt guy. So, but I feel like I'm pretty, competitive and pretty athletic and figured things out. And, I finally got the purple belt to tap on one thing, most of the time I'm getting tapped, but just, when you're getting smashed, like, and all the weight is on top of you, and you're like, I think I might die if I don't tap out, but I know I'm not going to die. And you're sitting there, you're trying to breathe. Like this guy was like 270. He was massive, but he was a white belt. So I know he didn't know what he was doing. And he was pretty much out of shape, but all of his weight was on top of me. And I'm just sitting there like, just relax, just calm your nerves, calm your breathing. You can get out of this. It took about 60 seconds of like, am I just going to tap and just give up because I'm going to anyways, I kept moving, got a little bit out. Somehow I got his gi around his neck, like taking his gi and like putting it out. It got around his neck. I don't know what I was doing. I started yanking on it. Somehow I throw my leg on top of that and I start yanking on it. And like there's people rolling all around Hunter. Like there's like 5 rolls going on. Coaches kind of in and out talking to different people. I don't know what I'm doing, except I'm just yanking. And I'm like, I'm just trying to make this as painful for this guy to get off of me, right? So I'm like, he can't get out. Now he's starting to struggle. I'm like, oh, maybe I got something here. So now it's like, I'm like riding a bull, you know, like, and like, so finally the guy taps out and I'm like, praise God, I'm alive. And he tapped out and coach is like it stops. He looks back and he can't quite see how it all ended. He's like, what happened? And the guy's like, I don't know. He's like, well, what happened? He's like, well, I tapped. He goes, well, what happened? He goes, I don't know. He had the thing. And he asked me, go, how I go, I don't know. I just put my thing around. I started squeezing like and pulling my as hard as I could. He's like, okay, well, good job. Anyways, jiu-jitsu will challenge you in so many ways. And that's my last thought for today. Hunter, wrap it up with anything else you want to add to that.
Yeah. I mean, you know, there's probably a lot of people listening to this right now that last part really resonates with them because that's, you know, you're going to attract some people that have a little bit of that. But for the people that are like, yeah, man, but that was me in my 20s, like, that's just like, it's accessible. It's literally one drive away. It's one go run, whatever the vibe is, pick a modality and like push it to the point where you have to give up something to get to where you want to go. And everyone else has had those thoughts as well. Like when you think, oh, but this doesn't apply to me because of my hip. You know, I think I've talked before, maybe even on this program, you know, I had a wrist injury and a respective surgery that made it so that I can't have any wrist inflection. I can't do push-ups. And yet part of the High Rocks race is to do something in the range of like 80 burpees. So how do you do a burpee if you can't bend your wrist? Like you just kind of figure it out. And it allowed me to, okay, I could do 2 things. I could go, oh, you know, I can't do burpees, so I can't do High Rocks. Or I could be like, well, I can just plant my wrist in this way that no one else does. And that's still within the rules. So cool. So like just freaking go. Effort is attainable to everyone. And then there's a good tie into the market there as well, which is that one of the reasons why Brett and I both like all this stuff and working out and getting strangled by huge monster men, who by the way are also really competitive. That's why they're in that same class, is that it will simulate these things which are so helpful in business and parenting and market cycles, which is that you become accustomed to something that is everyone else's worst case scenario. A 265-pound man trying to strangle you is what Brett does in his spare time. So when someone goes, oh no, flat tire, how you going to deal with it? He's like, flat tire, bro. Did you know where I'm coming from? So it feels good to walk around like that. And it's just something that is just a matter of getting accustomed to that stuff. So there's a reason. And like I said, if you're thinking this doesn't apply to you because of blank, that's exactly who I'm talking to, because that was me, man. I wasted my college partying, thinking about how I should have ran, blah, blah, blah. And it was one email away.
Beautiful. Hunter Thompson, for our listeners who want to get in touch with you, amen to all of that. How can they find you? And then we'll wrap it up.
I enjoy this as always, buddy. Raisingcapital.com. Check out asymcapital.com. And, you know, I really do think it's an opportunity. It doesn't have to be with me, but make it somebody. Go on yourself, education, and make some moves.
Amazing. Thank you, Hunter Thompson. Also, thank all of our listeners for listening to that episode of the Build Billions podcast, also on Capital Gains Tax Solutions podcast and YouTube channels. Hey, we're on this journey with you to scale from millions to billions so we can give more all the way to help MVPs, the most vulnerable people. I'm Brett Swarts. He's Hunter Thompson. And if you have a massive exit coming up, you need to build a capital gains tax exit plan. Before you do, stock, business, Bitcoin, real estate, go to capitalgainstaxsolutions.com so we can defer that tax, compound that wealth, multiply your freedom and impact. That's capitalgainstaxsolutions.com. Thanks, everybody. Talk soon. Bye.